Equity Market Update, December 2020. Calendar year 2020 was a seesaw year for equity markets globally, wherein it witnessed significant fall in March 2020, driven by significant uncertainty on growth and corporate earnings due to COVID-19 and lockdowns. However, the second half witnessed a sharp rebound on back of aggressive monetary and fiscal easing, high liquidity and lower cost of capital, recovery in economic activity post-easing in lockdowns, lower than anticipated impact on earnings and economy, positive news on vaccine developments and rollout, etc. In India, after falling to four-year lows in March 2020, S&P, BSE, Sensex and Nifty 50 scaled new highs and ended the year near all-time high. Nifty 50 ended the year up approximately 15% higher year-on-year. The small cap and mid cap indices outperformed the Nifty 50 and registered a year-on-year gain of 21%. This should be viewed in context of underperformance witnessed in mid caps and small caps over the past couple of years. Most of the key sector indices ended in strong gains, with healthcare and IT outperforming, while oil and gas and banking underperformed. Globally, most major indices also ended the year with good gains, but most underperformed Nifty 50 for the year. FPI sold $6.4 billion in Q1 CY20, with highest monthly outflow of $8.3 billion in March 2020. However, the flows reversed sharply, with FPIs buying $29.4 billion in the remaining 9 months. On a full-year basis, net FPI flows into equity stood at $23 billion as against $14.4 billion last year. However, domestic equity-oriented mutual funds witnessed outflows of INR approximately 25,300 crore in CY20 vis-a-vis net inflows of approximately INR 56,000 crore during last year. Outlook. The rally in the Indian equities from the lows seen in March 2020 has to be viewed in context of significant improvement in global liquidity and fall in interest rates, resulting in fall in cost of capital and sharp reversal of FPI flows, better than envisaged corporate earnings due to cost savings, etc. Interestingly, the impact of lower cost of capital can more than offset the impact of lower cash flows in 1 year. As on 31st December 2020, Nifty 50 was trading at price to earnings multiple of 18.7x based on FY22 estimated earnings. In our view, these are reasonable multiples, especially given the low interest rate environment. Further, the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield also remains below its 10-year average. Despite the current rally, Indian market capitalization is currently approximately 89% of GDP, which is reasonable especially in the context of lower cost of capital. At its bottom in March 2020, it had fallen close to 48%. While Nifty 50 is higher than pre-COVID levels, the rally has been relatively polarized, with top 5 stocks contributing bulk of returns. Further, since December 2017, the Nifty 50 has outperformed the broader markets, with share of Nifty 50 in overall market capitalization increasing to approximately 60%, which is near historical highs. In the past, it has been observed that such a phase of polarized returns is followed by broader markets outperforming Nifty 50. While this is seen from historical data, the same may or may not sustain in future. Polarized market returns are also visible in divergence in sector valuations, as reflected in rising standard deviation amongst the valuation multiples across sectors over the past few years. This table also highlights this polarization reflected in valuation multiples of select sectors being trading significantly above long-term average, whereas for few at a significant discount. Further, driven by cost reduction, the corporate earnings in Q2 FY21 was better than expected and resulted in broad-based earnings upgrade. Hence, markets hold promise over the medium to long term in our opinion. Sequential improvement in economic activity, favorable external scenario, monetary and fiscal measures undertaken, along with relatively better placed rural economy also support this optimism. In view of the above, there are reasons to be optimistic about equities. Investors' exposure to equities should be guided by their tolerance for volatility and their ability to hold for medium to long term. Significant rise in spread of COVID-19, unwinding of expansionary fiscal and monetary stimulus, sharp rise in crude oil prices, higher than expected NPAs post the moratorium, escalation of border tension between India and China, and/or trade tension between US and China, significant policy changes post-US elections, etc., are key risks in the near term. For more on our views on equities, please refer HDFC MF Yearbook 2021, published recently and available on our website www.hdfcfund.com. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.